Imagine a world where a few risky home loans could topple the entire global economy. Sounds impossible. Yet in 2008, that is almost precisely what happened. Millions of people lost their jobs, homes, and life savings, while massive banks teetered on the edge of collapse. In this video, we'll break down the 2008 financial crisis in 10 minutes, from its origins to the aftermath, and show how a combination of greed, overconfidence, and complex financial products created the perfect storm that shook the world. The buildup: easy money, housing boom, and risky loans. In the early 2000s, the US economy was booming, and interest rates were incredibly low. The Federal Reserve kept rates low to stimulate growth after the dot-com bubble burst. This made borrowing cheap, and banks were eager to lend money to nearly anyone. Mortgages were no longer reserved for people with strong credit. Lenders began offering subprime loans, high-risk mortgages to borrowers with poor credit histories or limited income. These loans often had adjustable rates, meaning that payments could start low and skyrocket after a few years. At the same time, housing prices were climbing rapidly. Many people believed that prices would continue to rise indefinitely, encouraging speculative buying. This created a housing bubble where homes were purchased not necessarily to live in, but as investments that were expected to grow in value quickly. To maximize profits, banks bundled thousands of mortgages, both prime and subprime, into mortgage-backed securities, MBS. These financial products were then sold to investors around the world, often rated safe by credit rating agencies despite containing risky loans. The combination of rising home prices, easy credit, and complex investment products created a fragile financial system. On the surface, everything seemed fine, but underneath, risk was accumulating at an unprecedented pace. When the bubble bursts, rising rates, defaults, and toxic assets between 2004 and 2006, the Federal Reserve gradually increased interest rates to curb inflation. These higher rates made adjustable-rate mortgages far more expensive for homeowners. Many subprime borrowers who had been able to make their initial low payments suddenly found themselves unable to keep up. Foreclosures began to rise, and homeowners who had assumed their homes would always increase in value were left owing more than their property was worth. As mortgage defaults increased, the value of mortgage-backed securities dropped sharply. Financial institutions that held large amounts of MBS faced massive losses. What was once considered a safe investment was now regarded as toxic. Banks, hedge funds, and other financial institutions were suddenly unsure of each other's stability. Interbank lending slowed dramatically because no one wanted to risk lending to a potentially insolvent institution. This created a ripple effect throughout the financial system, freezing regular lending and threatening broader economic stability. The collapse wasn't immediate, but it accelerated as more defaults occurred. By early 2007, subprime lenders were beginning to fail, signaling that the problem was systemic rather than isolated. Key collapses: major institutions fall, panic spreads. The situation escalated quickly in 2008. Large institutions that had invested heavily in mortgage-backed securities began to face enormous losses. Fannie Mae and Freddie Mac, two government-sponsored entities that dominated the U.S. mortgage market, were placed under conservatorship in September 2008 to prevent their failure. Their collapse could have destabilized the entire housing finance system. The tipping point came on September 15, 2008, when Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy. Lehman's failure was unprecedented in scale and sent shockwaves through global financial markets. Banks and investors panicked, stock markets plunged, and credit markets froze. The interconnectedness of global finance meant that problems in the U.S. housing market now threatened economies worldwide. Almost simultaneously, insurance giant AIG faced near collapse due to exposure to mortgage-backed derivatives. The U.S. government intervened with an emergency loan to prevent AIG from failing, recognizing that its collapse could create a domino effect throughout the global financial system. Other banks teetered on the edge of insolvency, highlighting how widespread and systemic the crisis had become. The collapse spreads. The economy grinds to a halt. As the financial system froze, the real economy suffered. Businesses struggled to access credit, slowing production and investment. Consumers facing job losses or declining wealth reduced spending. The result was a severe recession that affected millions worldwide. In the United States, around 7.5 million jobs were lost between 2007 and 2009, while unemployment rates soared. Many workers found it difficult to regain the same level of employment, and new jobs often paid less or offered fewer benefits. Foreclosures surged, and households that had relied on rising property values to build wealth found themselves underwater, owing more on their mortgages than their homes were worth. Retirement savings, investments, and personal wealth shrank dramatically. The crisis also had a global impact. Europe, Asia, and emerging markets experienced sharp slowdowns, rising unemployment, and banking instability. Countries like Iceland faced total banking collapses, while others, such as Greece, entered long-lasting debt crises. The ripple effects of the U.S. housing market exposed vulnerabilities in financial systems across the globe. Government reaction, bailouts, reforms, and rescue efforts. To prevent a total economic collapse, governments and central banks worldwide intervened. In the United States, Congress passed the Emergency Economic Stabilization Act of 2008, creating the Troubled Asset Relief Program, TERP, with $700 billion to purchase distressed assets and recapitalize banks. This program aimed to restore confidence in the financial system and stabilize credit markets. The Federal Reserve also launched aggressive monetary policies, including lowering interest rates to near zero and pumping liquidity into the financial system. These measures encouraged banks to lend and helped restore some stability in the markets. Globally, central banks coordinated actions to prevent a worldwide economic meltdown. Aftermath: a changed world. The financial crisis left a long-lasting impact on the global economy. Many households never fully recovered from the loss of wealth, and unemployment remained elevated for years. The housing market took a decade to regain pre-crisis levels in many regions, and the crisis reshaped attitudes toward risk, finance, and homeownership. For ordinary people, the lesson was clear. Even distant, complex financial products can have real-life consequences. Millions of homeowners who had assumed that rising home prices guaranteed security learned a hard lesson about leverage, debt, and risk. The crisis demonstrated the fragility of financial systems and the importance of transparency, oversight, and responsible lending. The 2008 financial crisis began with a simple idea: make home ownership accessible to everyone. But excessive risk-taking, overconfidence, and complex financial products turned that idea into a worldwide disaster. Millions lost jobs, homes, and life savings, and major financial institutions collapsed or were rescued by governments. The crisis reshaped the global economy, leaving a legacy of cautious regulation, heightened awareness of systemic risk, and a reminder that financial bubbles, if unchecked, can have devastating consequences. Understanding the 2008 crisis is more than a history lesson. It's a warning about what can happen when greed, poor oversight, and complexity combine in financial markets. The next crisis may be different in form, but the lessons remain the same. Vigilance, regulation, and responsible lending are essential to preventing another global economic collapse. If you like this video, hit subscribe for more deep dives into the finance world. Drop a comment if you want breakdowns of other confusing finance terms. Thanks for watching.